Dealing with emotional trading is one of the most difficult and unavoidable challenges a trader will ever face. Not because emotions are a flaw, but because trading places human psychology in direct contact with uncertainty risk and immediate feedback. Emotional trading is not a sign that you are weak or undisciplined. It is a sign that you are human, operating in an environment that continuously presses on fear, greed, ego, and self-worth. Trading literature written by those who last long enough to speak honestly is clear. On one point, the goal is not to eliminate emotion, but to prevent emotion from secretly making decisions on your behalf. The first step in dealing with emotional trading is understanding where emotions actually come from. Most traders believe emotions arise from price movement, but this is only partially true. Emotions arise when price movement conflicts with expectations. Fear spikes when the market moves against what you hoped would happen. Greed spikes when the market moves in your favor faster than expected. Anxiety grows when outcomes are uncertain and risk is poorly defined. This means emotional trading is rarely about the market itself. It is about the gap between reality and what the trader emotionally needed the market to do. Closing this gap is the real work. One of the most effective ways to reduce emotional interference is defining risk before entering a trade. Emotion thrives in ambiguity. When you do not know how much you can lose, every tick feels threatening. When risk is predefined and accepted in advance, the nervous system relaxes. Losses may still occur, but they no longer feel like emergencies. Trading literature repeatedly emphasizes that calm is a structural outcome, not a mental trick. You do not calm yourself down after the trade is on. You design the trade so calm is possible from the beginning. Another powerful tool is slowing down the decision-making process. Emotional trades are almost always fast trades. They feel urgent, justified, and obvious in the moment. Simple delays, such as waiting for a candle close rereading entry criteria or stepping away from the screen for 30 seconds, dramatically reduce impulsive behavior. These pauses interrupt the emotional momentum long enough for rational thought to re-enter. The goal is not hesitation, but interruption of automatic reaction. Journaling plays a central role in managing emotional trading, but only when it includes emotional context, not just technical details. Recording what you felt before, during, and after a trade exposes patterns that memory alone will hide. Over time, traders begin to see that emotional trades cluster around specific states: frustration after losses, excitement after wins, boredom during slow sessions, or fatigue late in the day. Once these triggers are identified, preventative rules can be created. Emotional trading becomes predictable, and what is predictable can be managed. Another critical strategy is separating identity from outcome. Many traders unknowingly use trading to validate intelligence, discipline, or self-worth. When this happens, every trade becomes emotionally charged. Wins feel like confirmation. Losses feel like rejection. Trading literature consistently warns that this is a dangerous attachment. The market does not reward who you are. It responds only to behavior. Traders who reduce emotional trading learn to measure success by execution quality rather than profit. A well-executed losing trade becomes emotionally neutral. A poorly executed winning trade becomes unacceptable. This shift alone removes enormous emotional pressure. Position sizing is also deeply emotional. Trading too large amplifies every feeling. Fear becomes panic. Greed becomes recklessness. Reducing size is one of the fastest ways to regain emotional control. Yet many traders resist it because smaller size feels like regression. In reality, smaller size creates psychological safety, allowing discipline to reassert itself. Trading literature often notes that the fastest way to improve behavior is not better analysis, but lower emotional intensity, and position size is the most direct dial for controlling that intensity. Environment design is another overlooked but powerful factor. Constant news, social media commentary, and other traders' opinions amplify emotion. Emotional traders often believe they need more information when what they need is less noise. Reducing inputs during trading hours protects focus and reduces reactivity. A quieter environment leads to quieter decisions. This is not ignorance, it is selectivity. Perhaps the most important mindset shift in dealing with emotional trading is accepting that emotions will never disappear. Waiting for emotional neutrality before trading is a mistake. Skilled traders feel fear, greed, doubt, and excitement regularly. The difference is that these emotions no longer dictate action. Systems, rules, and routines do. Emotion becomes background data rather than a steering wheel. Ultimately, dealing with emotional trading is not about control through force, but control through design. You do not overpower emotion, you work around it. You build structures that limit damage when emotion spikes and habits that restore balance when it fades. And it is precisely here, when emotions are acknowledged rather than resisted, that trading begins to feel calmer, clearer, and more professional, not because emotion is gone, but because it is no longer secretly in charge. And this is where the deeper work of mastering emotional trading has not yet fully reached its end. Because once emotion is no longer denied, it becomes something you can work with, rather than something you must fight. This is the point where many traders misunderstand emotional mastery, believing it means feeling less. In practice, it means noticing more and reacting less. Emotions become signals instead of commands. Fear signals unclear risk. Greed signals overstimulation. Frustration signals misaligned expectations. When these signals are read early, behavior can be adjusted before damage is done. Emotional control in trading is not a state, it is a feedback loop. At this stage, traders begin to recognize the early physical cues of emotional escalation. Tight shoulders, shallow breathing, increased screen fixation, rapid, clicking internal urgency. These signs appear before rules are broken. Treating them as risk alerts changes everything. Instead of asking, "What should I trade?" now the trader asks, "What state am I in right now?" If the state is compromised, exposure is reduced, or the session is ended. This is not avoidance, it is professional self-regulation. Trading literature often highlights that the best traders stop, not when they are losing the most, but when they are most likely to lose discipline. Another advanced technique is pre-commitment. Decisions made in calm states are more reliable than decisions made in emotional ones. Traders who manage emotion well decide in advance how they will respond to common emotional scenarios. What happens after 2 losses in a row? What happens after a big win? What happens when boredom sets in? These responses are written into the plan. When the situation arises, action is automatic. Emotion is bypassed without being suppressed. This is one of the most effective ways to prevent emotional trading from escalating. Over time, traders also learn to shorten the emotional half-life of outcomes. Instead of carrying wins and losses forward, they contain them within structured review periods. After the session ends, outcomes are documented lessons extracted and then deliberately put away. This containment prevents emotional residue from leaking into the next session. Without it, yesterday's trade unconsciously influences today's decisions. Trading literature consistently shows that emotional carryover is one of the most common hidden causes of inconsistency. There is also a critical relationship between emotional trading and expectations. Traders who expect smooth progress suffer the most emotional turbulence. Those who expect uneven outcomes experience less. This does not mean pessimism. It means realism. When drawdowns and mistakes are expected, they do not trigger identity threats. They trigger process checks. Emotional stability increases when expectations align with statistical reality rather than hope. As emotional mastery deepens, something unexpected happens. Confidence becomes quieter. There is less need to prove anything to the market. Trades are taken because they fit, not because they feel good. Losses are accepted without story. Wins are managed without excitement. This neutrality is not apathy, it is clarity. It allows traders to see what is happening rather than what they want to happen. Perhaps the most important realization is that emotional trading never disappears completely. Even highly experienced traders feel emotion. The difference is that they no longer negotiate with it. Rules, routines, and boundaries do the negotiating instead. Emotion is acknowledged, noted, and allowed to pass without being given the authority to act. This is the highest level of emotional discipline, not suppression, but delegation. In the end, dealing with emotional trading is about designing a system that assumes you will feel things and prepares for that reality. When systems are strong, emotions are harmless. When systems are weak, emotions are dangerous. Mastery comes not from becoming emotionless, but from becoming predictable in how you respond when emotion appears. And it is through this predictability, repeated day after day, that emotional trading gradually loses its power and is replaced by a steadier, more professional way of engaging with markets. One where clarity survives, pressure, and discipline holds even when feelings fluctuate, allowing skill to express itself over time without being drowned out by momentary internal storms.